welcome to the Deep Dive. Today, we're taking a really close look, at News Corp's Q1 fiscal 2026 earnings call.
And we're going to focus just on the opening remarks from the CEO, Robert Thomson.
Because that's where the real story is. Our mission here is to synthesize his perspective, where the company found success.
Which was mainly Dow Jones and their real estate arm.
Exactly. And also where they faced what he called blustery wins, which was in book publishing.
But maybe the most important part, the real headline, is the aggressive new stance they're taking on AI and intellectual property.
That's the part that I find so fascinating. You have this company, they're coming off a record profitable year in FY 2025. Q1 continues that trend.
Right. Revenue and profitability are both up, mostly from digital.
But then you have this almost philosophical defense of data, of their IP, in the age of AI. It's a really surprising juxtaposition.
It is. It's this story of, on one hand, stable, traditional financial growth, and on the other, this high-stakes, almost existential battle over the value of information itself.
Okay, so let's start with the basics then. Let's unpack the high-level financial performance. I mean, for Q1, it was undeniably solid.
Oh, absolutely. The numbers really reinforce the strength of their digital core. Thomson pointed out that revenue was up 2% year over year.
Which hit $2.14 billion.
Yeah, and, 2% might sound kind of modest, but when you think about the global ad markets right now, how volatile they are, that consistency is actually a sign of real structural strength.
That's a great point. And what about profitability?
Also good. Total segment EBITDA was up 5% to $340 million. And adjusted EPS saw a nice little bump, too, from 20 cents to 22 cents.
And they showed how confident they were in that strength with their capital strategy, right?
Oh, yeah. The share buybacks. They materially increased the rate.
Which basically means they're putting serious cash where their mouth is, betting on themselves.
It's a huge move. The CEO said their cash position is robust, and they're expecting very strong free cash flow this fiscal year.
So when a company does that, when they accelerate buybacks, it's management shouting from the rooftops that they think their stock is cheap.
Exactly. Thomson was so explicit. He said the shares are undervalued given the sum of our valuable parts and our profit trajectory. He thinks the market just isn't getting it yet.
Okay, so that confidence, that cash, is funding what comes next. And this is where, for me, it gets really interesting. The whole IP and AI discussion.
The language he used it was less like a CEO on an earnings call and more like a strategic declaration of war.
It was almost poetic, right? He was so intense about it.
He was. He made it crystal clear that their data, their content, is the essence of AI. This isn't just about, protecting a few news articles. It's about the fundamental value of their entire data library.
I loved the quote where he called AI without their content empty, vacuous, ignorant infrastructure.
And he didn't stop there. He followed it up with that whole string of analogies.
Oh, those were great.
AI without IP is like, what was it? Electricity without alacrity, buildings without billings?
Chips without chops. It's just such a memorable way of framing it. He's saying the tech itself is worthless without the fuel.
He's making the data the active ingredient. And that leads to their strategy, which is, it's kind of a carrot and stick approach.
Partnership, but with a huge legal threat backing it up.
Precisely. He was very quick to point out that, in his words, enlightened companies and wise courts are starting to get it. They're deciding that content has to be paid for, not just stolen.
And a shout out to Sam Altman and OpenAI was really telling.
It was. He literally saluted them for getting it, for understanding the inherent intrinsic value of actual intelligence.
So he's basically signaling that there are good actors out there who are willing to pay. A commercial path exists.
It does. And he mentioned that the weaving and sewing continues at pace with other AI players. So, expect more partnership announcements soon. But that only works because of the stick.
The legal hammer.
Yeah.
And that hammer is absolutely massive. We have to talk about that Anthropic case.
The $1.5 billion award. That's not just a fine. That's a global market signal. It changes everything.
It sets a precedent, right?
It's foundational to this whole strategy. That number, $1.5 billion, it puts a monumental price tag on proprietary content. Suddenly, every large language model is looking over its shoulder, wondering what stolen goods are in its system.
And Thomson's warning was just unmistakable.
If you have received stolen goods, we intend to pursue you relentlessly.
It's less a threat and more of a promise. He's saying content crime will not pay, and we now have the cash and the legal precedent to make sure of it.
So if that legal battle is the future, let's talk about how they're funding it today. Let's start with Dow Jones, who was clearly the star of the quarter.
Absolutely the star. Dow Jones had a fantastic quarter, and it really shows you where the high-margin money is. EBITDA was up 10% on a 6% revenue increase.
And the real story is in the details, right? It's not just the Wall Street Journal.
No, not at all. It's the high-margin B2B data stuff. Risk and compliance revenues, which is a pure data product for businesses, they surged 16% year-on-year.
16%. Wow.
And Dow Jones Energy was up 7%. This is that stable subscription engine that doesn't care about the ups and downs of the ad market.
And then there was that acquisition eco movement, which at first seems a bit weird. Why is a news company buying EV charging station data?
Because they know the value of specialized data that nobody else has. It's a pure infrastructure play. It expands their data moat. Now they're selling unique data directly to car makers and map providers.
Smart. So they're digging deeper into that B2B data world.
They are. And at the same time, the consumer side is still booming. Total subscriptions up 8% to 6.4 million. Digital-only subs for the Journal jumped 11%.
And the big shift is complete, basically. Digital advertising is now, what, 68% of their total ad revenue?
A record 68%. They are so much less exposed to the old, expensive world of print.
And that trend seems to be mirrored in their other huge revenue engine, digital real estate services.
It is. I mean, they delivered really strong results, even though the housing market has been, let's say, challenging. But the CEO seems to think that's about to change. He talked about the beginnings of an expected renaissance in the U.S. market.
Yeah, he's betting that with mortgage rates starting to come down, maybe approaching 6%, that'll finally get people moving again.
And even before that happens, Realtor.com still pulled a 9% revenue boost.
They did. And their strategy is smart. They're not just focused on one thing. They're targeting the sell side, new homes, and rentals. That's 22% of their revenue right there.
They also seem really aggressive about their position against competitors like Zillow. What's their argument there? What's their moat?
Their argument is uniqueness and quality. They're not trying to have the most listings. They're trying to have the best experience. They cited ComScore data saying they are the biggest publisher of original real estate news in the U.S.
So the idea is that better content brings in more serious buyers.
Exactly. He claims it leads to better user metrics, like the most visits per user. And he said they are clearly outstripping Zillow and other lesser sites. It's an audience quality argument for sure.
And this is playing out globally too.
Yeah, REA Group in Australia saw revenue rise 3%. They're seeing increased signs of life, especially with auctions in Melbourne and Sydney. And all of that led to a really healthy margin improvement for the whole segment, up to 33%.
Okay, so you have two massive, high-margin digital segments just firing on all cylinders. So now let's pivot to the tougher spots. The blustery wins.
Right, which was mainly book publishing.
Yeah, that was the one noticeable weak spot. Uncharacteristically weak was the term he used.
And you really have to understand the context. The comparison to last year was just brutal.
Because of the J.D. Vance book, Hillbilly Elegy?
Exactly. After his VP nomination, that book had a dramatic resurgence. That's a huge one-time sales spike that just makes the next year's numbers look bad no matter what.
And on top of that, they took a real financial hit. A $13 million write-off.
Yeah, for a book distributor that's expected to close, that's a structural cost of being in that older part of the business.
But he did say things are starting to look up. He mentioned some new bestsellers.
He did. R.F. Kuang's Catabasis and new stuff from Mitch Albom and Brett Baer. But the most striking thing in the entire presentation
was the part about religious books. So strange to hear on an earnings call.
It was so specific. He pointed to an elevated interest in the Bible following the tragic assassination of Charlie Kirk.
The numbers were staggering. September Bible sales revenue was up more than 65% from the year before.
And he said it was driven by a significant influx of new and younger customers.
It just goes to show how quickly these huge, often tragic external events can shift consumer behavior in really specific ways.
Absolutely. The CEO is just documenting a correlation, not causation, but it's a powerful example of how sensitive that market can be.
Okay, so finally, let's touch on news media. Revenue growth was tiny, just 1%, but the efficiency gains were huge.
That 1% number is so misleading. The real story is that EBITDA grew a resounding 67%. That tells you they have gotten incredibly good at cutting costs and running these things as lean digital machines.
And the New York Post seems to be a big part of that. Ad revenue up 19%, almost 90% of it digital.
And they're not retreating, they're expanding. They're getting ready to launch the California Post early next year.
And that digital focus is working in the UK as well.
It is. The Times and Sunday Times added 40,000 digital subscribers, up to 640,000 now. It all adds up. The overall margin for news media jumped from 3.3% to 5.5%.
So let's tie it all together. When you step back and look at the whole picture from his perspective, what's the big takeaway from this deep dive?
The overriding takeaway is that the strategy is working. The Q1 results prove they can successfully fund their massive legal war on IP theft. They're using the cash from high-margin digital businesses like Dow Jones and real estate to become a kind of global IP enforcer.
They've moved beyond just selling content.
Way beyond. They're demanding rent for access to the core fuel of the entire AI economy.
And when you look at those key metrics, 6.4 million subscribers at Dow Jones, that's 67% EBITDA growth in news media, the constant mention of the $1.5 billion Anthropic award, you see the scale, the efficiency, and the legal muscle all working together.
Which brings us back to that first point, the philosophical defense. And it raises a really important question for you, the listener. If News Corp is succeeding by doing this, and if courts are putting these massive valuations on copyrighted data,
It makes you wonder, for any business out there that relies on its own proprietary data or content, what assets might you be drastically undervaluing right now? Especially if you haven't really thought through your strategy against scrapers and AI models.
the fight for the essence of AI is really just beginning. But News Corp has definitely set the price of admission very, very high.
Thanks for joining us for this deep dive. Keep exploring.